Have you ever heard the incredible story of Ronald Reed? This guy, he was a janitor, worked at a gas station too, I think, up in Vermont.
Oh, yeah. The one who seemed super frugal. Patched up coat, old car, that whole thing.
Exactly. Lived really simply. But then, get this, when he passed away back in 2014, turns out he'd quietly built up a fortune, like $8 million.
It's just wild, isn't it? And the really amazing part is how he didn't, invent something or win the lottery. No big inheritance.
Yep.
He just saved consistently and let compounding do its work over, decades.
It really flips the script, doesn't it? We're always told you need the fancy education, the Wall Street job,
Mm-hmm.
But the sources we looked at, especially Morgan Housel's insights, they argue something, pretty different.
Yeah, that financial success isn't really a hard science, not about complex formulas.
Yeah.
It's actually more of a soft skill.
A soft skill? How so?
Well, it's about your behavior, your temperament, how you react emotionally to money stuff. That's way more important, apparently, than your IQ or where you went to school.
Okay, so that's our mission for this deep dive then. Forget the spreadsheets for a bit. We're digging into the psychology.
Right. We've pulled out 5 key behavioral things from the sources, 5 mindsets that seem to make or break building and keeping wealth.
Let's jump into the first one. Seems like a big hurdle.
Okay, so the forked idea starts simple. Fees. Like if you buy a really nice watch, something custom maybe, it costs money, you pay the price.
Right. You don't argue about it. You just accept that's the cost of the thing you want.
Exactly. But with investing, especially when we're aiming for those really good long-term returns, we kind of forget there's a price, or we wish there wasn't.
And that price isn't just brokerage fees, is it?
No. The real price, the unavoidable cost for potentially high returns, is volatility, market swings, ups and downs, sometimes big downs.
So if you want returns better than just parking your money somewhere super safe, you have to accept discomfort.
Pretty much. High returns often come from portfolios that aren't perfectly diversified, maybe a bit concentrated, and that just means bigger swings. Volatility isn't some kind of penalty you pay if you mess up. It's more like the admission ticket, the cost of entry for potential wealth growth.
Okay, intellectually I get that. But emotionally, that's a whole different ballgame, isn't it?
Totally different. And that leads to the real question for you listening. How much are you actually prepared to pay? Mentally, emotionally, could you really watch your savings drop 30% or 50% and just sit tight?
That's the gut check.
Yeah.
And the sources use a great example, Netflix. Imagine 10 years back, you saw it coming. Streaming's the future, Netflix is going to be huge. So you put a chunk of money in.
You'd be feeling pretty good today, right?
Right. But would you have actually made it through the journey?
That's the kicker. Because most people probably wouldn't have. Remember 2011?
Vaguely. What happened?
Well, they made some changes, lost a load of customers, and the stock just tanked. Dropped 80% from its high. 80.
Oof. 80%. That's not just a dip. That feels like game over.
Exactly. So imagine seeing that on your statement.
Yeah.
How do you go home, look your partner or your kids in the eye, and say, yeah, I know our savings just got vaporized, but trust me.
The sheer terror of that. Yeah, I can see how people bail.
Right. And look, this kind of wild ride isn't just for risky tech stocks.
Yep.
Even something supposedly safe, like the S&P 500 index.
Even that has a rough price.
Oh, yeah. If you'd been invested steadily since, say, 1980, the data shows you would have spent something like 13 years total, with your portfolio down 20% or more from its peak.
13 years? Wow.
And about 8 specific months where it was down a full 50%.
Huh?
Half gone.
Okay.
The long-term returns were fantastic, obviously, but they didn't come smoothly. They came with serious stomach-churning periods of pain.
So volatility isn't a flaw in the system. It's the feature that filters people out. It's the price. You got to pay it.
You got it. Pay the price.
Okay, so if volatility is the price of admission to potentially getting wealthy, what happens once you actually have some wealth? Seems like there's another trap waiting.
Oh, absolutely. This one's maybe even trickier. It's the feeling of never enough.
Keeping up with the Joneses, writ large.
Kind of, yeah. Capitalism is amazing at creating wealth, right? But it's equally amazing at creating envy. And that envy can just poison any enjoyment you get from your own success.
Mm-hmm.
There's this classic example, right? Someone gets a $2 million bonus. They're thrilled, on top of the world.
That's pretty good to me.
Yeah. Until they hear the person in the next office got $2.1 million.
Ouch.
Suddenly, that $2 million feels inadequate. They're not celebrating anymore. They're actually sick about the difference. The comparison just shifted the goalposts instantly.
That social comparison thing is brutal, and the sources had this amazing anecdote tracing it all the way up the ladder, right?
Yeah, it's fascinating. So imagine Bill. He makes, say, $500K a year, doing really well, top 1% income in the U.S., feels pretty rich.
Okay, good for Bill.
Until he buys a place in the Hamptons. And his neighbor Stan is a CEO pulling in $10 million a year. Stan's in the top 1% of the top 1%. Mm-hmm. Suddenly, Bill doesn't feel so rich anymore.
Right. Stan's playing a different game. So Stan, at $10 million a year, he must feel like he's made it. Content?
You'd think so. But no, Stan hangs out with Michael Jordan. Jordan's fortune is what? Getting close to $2 billion?
Okay, now we're talking truly insane numbers.
Right. So compared to Jordan's wealth, Stan's $10 million income starts to feel, well, not small, but just not in the same league. He's comparing himself upwards again.
All right, but surely Michael Jordan with billions. He can stop comparing, right? Who's bigger than MJ?
Well, according to the anecdote, Jordan goes to these exclusive parties, and guess who might show up?
Don't tell me. Bezos.
Jeff Bezos, who in 2020 alone saw his net worth jump by $75 billion, sitting on maybe $200 billion total.
That's just mind-bending.
So even Michael Jordan, a billionaire, is looking up at someone whose wealth is just astronomically larger. The point is, there's always a bigger fish, always someone with more.
And trying to catch that bigger fish is pointless, dangerous.
Exactly. That feeling of never enough, that constant comparison, it drives people to do really stupid things, leveraging up their investments way too much, maybe even illegal stuff like insider trading.
Risking everything they already have.
Risking what they have and need for something they don't have and, frankly, don't need. It leads to ruin, jail, worse.
So the lesson isn't about climbing higher on the comparison ladder.
No. The lesson is simple, but hard. Define your own finish line. Figure out what enough means for you, personally. And never, ever risk the important things, your security, your family, your peace of mind, chasing something extra you don't truly need.
All right, let's shift gears a bit. We've talked about our own psychology, but what about how we view other people's money choices? You see someone spending lavishly when they seem broke or not saving, and the immediate thought is often, that's just crazy.
Yeah, we judge pretty quickly, don't we? And that judgment usually comes straight from our own little bubble, our own upbringing, our own experiences with money.
We forget that people come from vastly different places.
Completely. Different childhoods, different economic realities, different opportunities, different fears. Yeah. It all shapes how you see money and risk. What looks totally nuts to you might actually make perfect sense from someone else's perspective, given their life story.
The sources had a really powerful example for this, didn't they? Something about lottery tickets.
Yeah, this one really makes you think. In the U.S., the lowest income households spend, on average, something like $400 a year on lottery tickets.
Oh, okay.
Which is about 4 times what the highest income group spends.
4 times? Wow. And that seems crazy when you hear stats like, what is it, a third of Americans can't cover a $400 emergency?
Exactly.
Yeah.
So from a certain viewpoint, spending your potential emergency money on lottery tickets looks like pure financial self-destruction. Why would they do that?
Right. It seems illogical. So how do the sources suggest we understand it? Not excuse it, maybe, but understand it.
It's about understanding the function it serves for that person. If you're living paycheck to paycheck, if you don't see any realistic way to save a meaningful amount, if college or even a decent vacation seems impossible, that lottery ticket isn't really an investment strategy.
It's something else.
It's hope. It's buying a dream. Maybe the only dream that feels accessible. The sources argue it's a small price for a glimpse, however tiny, of completely different life. They might not feel they have the luxury of long-term saving. The lottery offers immediate, albeit astronomically unlikely, transformation.
Okay, I see. It's a different calculation based on a different reality?
Precisely. And recognizing these different financial realities is super important for us as investors, too.
How so?
Well, it stops you from just blindly copying what someone else is doing. You see a billionaire's portfolio, maybe very conservative. Their goal is probably stay rich, capital preservation.
Right.
But if your goal is still get rich, you likely need to take on more risk than them. Their strategy doesn't fit your situation or your tolerance for bumps along the way.
Makes sense.
You need to understand your own goals, your own risk profile, your own circle of competence, as Buffett calls it. Don't jump into things like maybe those crazy GameStop surges just because others are, if it doesn't fit your plan and understanding. What seems rational for a day trader might be truly crazy for your retirement fund.
Let's talk about the big shocks, the things nobody sees coming. The Great Depression, World War II, maybe the '87 crash, 2008 COVID, these massive events that just change everything.
Right. The black swans, that term Nassim Taleb made famous.
What defines a black swan technically?
Well, he gives three main characteristics. First, it's an outlier. Nothing in the past really suggested it could happen. It's totally unexpected.
Okay. Unexpected.
Second, it has an extreme impact, huge consequences, globally often.
Right. And the third one, this is the sneaky one, isn't it?
Yeah, this is the psychological trap. A black swan only seems explainable after it happens.
Yeah.
In hindsight, we create narratives, we connect dots, and we fool ourselves into thinking we should have seen it coming.
Oh, the signs were there.
Exactly. But they weren't obvious beforehand. And this ties into what we worry about day to day. We obsess over the stuff we can see and talk about government debt, inflation numbers, the next election.
The known worries, the things filling the headlines.
Right. Those are the known unknowns, maybe. But the things that truly derail markets and reshape the world, they tend to come out of left field, completely unforeseen.
So how on earth do you prepare for something you can't even imagine?
Well, that's the million-dollar question, isn't it? The temptation is always to try and predict the next crash, to time the market. Let's get out before the bad stuff happens.
Yeah, listen to the gurus, read the forecasts.
But the data shows that trying to dodge the downturns is incredibly costly. It often backfires badly.
There's a specific stat on this, right? About missing the best days.
Yes, and it's staggering. Get this. If you were invested in the S&P 500 for, say, 20 years, but you somehow managed to miss the 4 best performing days in the market during that whole time, just 4 single days.
Okay, missing 4 days out of 20 years, your return takes a bit of a hit.
A massive hit. Your total return drops from around 291% down to just 164%.
Wow, missing just 4 days almost halves your total return. How?
Because the market's best days often happen right after the absolute worst days, during periods of peak panic and volatility. If you panic and sell during the crash, you almost certainly miss the sharp rebound that often follows immediately after.
So trying to be clever and jump in and out is actually really dumb.
It's incredibly difficult to do successfully, and the cost of getting it wrong is huge. The real lesson isn't about predicting the unpredictable, it's about building resilience.
Resilience, meaning?
Meaning having a financial plan and enough cash reserves or low debt, and crucially the mental fortitude to ride out the shocks you cannot see coming. Prepare for the fact that bad stuff will happen even if you don't know what it is, rather than trying to guess the specifics.
Okay, final takeaway. This one's about, well, why negativity seems so smart. You know how the person predicting doom always sounds more intelligent and serious?
Well, the optimist often sounds kind of naive, maybe even a bit clueless.
Exactly. Why is that? It feels like bad news just gets more weight.
It absolutely does, and there's a deep evolutionary reason for it. Daniel Kahneman called it loss aversion, or an asymmetry toward loss.
Meaning we hate losing more than we like winning?
Pretty much. Think back to our ancestors, the ones who paid super close attention to potential threats and the rustle in the bushes that might be a lion, were more likely to survive than the ones who were just optimistically focused on finding berries.
So we're literally wired to prioritize bad news. Fear kept us alive.
Exactly. We're descended from the warriors. And this gives pessimism a huge narrative advantage today.
How so?
Well, think about progress. Good things like life expectancy slowly rising, or technology getting cheaper and better, or global poverty declining. These things happen gradually, incrementally, over long periods.
Right. They don't make dramatic headlines day to day.
Exactly. Optimistic stories are often kind of boring. They require zooming out, looking at long trends. But setbacks, disasters, market crashes, they happen fast, suddenly.
Very dramatic. Easy to make a story around.
Right. It's easy to build an intriguing and persuading story, as the sources put it, around an immediate crisis or a looming threat. Those stories grab our attention because our brains are primed for threats. They get clicks, they get shared, they reinforce that feeling that things are always on the brink.
So you hear about inflation or U.S. debt or some new virus variant, and it feels urgent, immediate, real. But the fact that, I don't know, computing power is still exploding exponentially, or sustainable energy is getting dramatically cheaper, that just gets a shrug, lacks the punch.
Precisely. It doesn't trigger the same threat response. So just knowing this bias exists is incredibly important. It's like psychological armor.
You have to actively fight the pull of pessimism.
You have to consciously seek out the counter-narrative. Look at the long-term data. Remember people like Hans Rosling, who showed that on many important measures, the world is actually way better than most people think? You need that balance against the constant drumbeat of gloom. Hashtag, tag, outro.
Wow. Okay, that was a really insightful deep dive. We've basically established that making money and keeping it seems way less about complex math and way more about, well, mastering ourselves, our behavior.
Yeah, it really boils down to psychology. We hit those 5 key mindsets. First, you got to accept volatility. It's the price you pay for potential returns.
Right, pay the price.
Second, watch out for that never enough trap. Define your own goals. Ignore the comparison game.
Avoid envy. Got it.
Third, respect that other people see money differently based on their own lives. What seems crazy might make sense to them.
Different perspectives. Okay.
Fourth, prepare for the unexpected. Build resilience for those black swans you can't predict rather than trying to time the market.
Prepare for the unknown.
And finally, understand that pessimism sounds smart, but optimism often wins in the long run. Recognize our bias towards bad news.
Don't get seduced by pessimism.
Okay.
Okay, so the sources really hammer home this point. Often the smartest financial move, especially during chaos, is just doing nothing, staying the course.
Exactly. Resisting the urge to react.
So, if that's true, if inaction is often the wisest action, here's the final thought we want to leave you with.
Knowing yourself, knowing your own triggers and biases, and knowing the market will eventually test your patience. What specific belief or habit are you most likely to fall back on that could sabotage your own financial future when things inevitably get scary again? Thinking about that, that's where the real work begins.